time when people start learning something, they can't remember all the details just because they haven't mastered the art yet. So as in trading, there are so many aspects that you need to remember. In order to help you, let's make a checklist for beginner traders. My name is Sam Newton and I recommend you watch this video till the end to know how to work with the trend, support and resistance levels, strategies and many more. 1. Where is the trend going? As it said, the trend is your friend. By applying the analysis of higher time frames than the usual hourly or minute time frames during day trading, you can identify long-term and strong trends for trading and making a profit. Typically, breakouts usually occur after a period of low volatility. So pay attention to potential breakthroughs, as you don't want to be caught off guard when they occur. Some assets tend to trade in ranges. You can use fluctuating indicators such as RSI, CCI and stochastics to trade range markets. Thus, when making any trade, check if prices are in a trading or range phase and if trading in a range or trending market is part of your trading plan. Traders should ask themselves if the price is in a strong trend and if they want to trade with the trend as part of their trading plan. 2. Where are the support and resistance levels? Before starting your trading day, it is important to identify key resistance and support lines across your positions to know the range where you should be trading in. Even if you don't use support and resistance in your live trading system, this is a very common trading concept, and millions of traders follow support and resistance levels. Usually, the price action tends to follow certain price levels for many reasons, and one must be able to identify these levels. Traders don't want to enter a long position that has a key resistance level nearby only to bounce down. The same thing happens when the price reaches a key support level and usually bounces after it. Trend traders should look for breakouts of these levels as they indicate that the market may be trending. However, range traders will look for prices that fluctuate between support and resistance for extended periods of time. 3. What strategy is suitable there? Of course, every trading day can be different, and from time to time you can be a swing, day trader or scalper. There is no right or wrong. It is completely dependent on what works for you. One of the easiest steps to choosing the right strategy is to take a look at the economic calendar for the day. Important upcoming news typically slows down the market prior to the news announcement. And at the moment of publishing, the volatility is impressive. Moreover, traders should consider that indicators help traders to confirm trades with high probability. Depending on their trading plan as well as their strategy, traders should have 2 to 3 indicators that complement their trading strategy. You should not complicate their analysis by adding several indicators to one chart. They should keep their analysis clean, simple, and easy to see at a glance. 4. How long do I want to hold my order? There is no time limit in the position holding period in Forex. To understand how long it is preferable to hold your position, you need to choose the entry moment carefully. Moreover, it strongly depends on your take profit. You can hold the trade until your target is reached. It can be an hour or a week. However, if you can't see the end of your order, maybe it's better to close it in order not to have a big loss. 5. How much am I ready to lose? Get a clear understanding of risk management. This may not be the most pleasant side of trading, but it is more important than technical analysis. Before placing an order, you should ask yourself how much of their capital you are willing to risk on a single trade. There are times when traders use all their capital in a single trade and also start to expand an account when they are too confident in a single trade. This can be avoided by limiting the amount of capital used in a single trade. In addition, you can set stop loss on all trades so that the total amount of risk does not exceed 5% of the account balance. 6. What is the potential target? Knowing your target can really calm your mind, as you can reckon when you can finish. That's time to talk about the risk-reward ratio. The risk-reward ratio is the ratio of the number of points traders are willing to risk to reach their target. Traders must have a positive risk-to-reward ratio such as 1 to 2, which means the trader risks half of what they can get if the trade works out. Thus, traders must consider the risk-reward ratio before executing any trade order. Also, don't forget, by calculating position size, you can see your potential profit, so it's easier to take profit and aim for your target. 7. Keep calm and trade Forex. Psychological aspects do influence traders' performance. Emotions often affect our ability to look at the market clearly and to think in a cold-headed fashion. It's better not to trade when you're nervous or tired, as it can bring a bad experience for you, irritating and annoying. Try to keep a relaxing mood and be attentive. Don't rush and everything will be alright. So I hope that this checklist was interesting for you, and here is the bonus for you. You can download this checklist in the description. Good luck and bye bye.